Some single premium stories. So that scared me for a second. First, I want to start. Let's start the discussion about MEC. It is not a 4-letter word, and it's not because it's only 3 letters, but it's not a 4-letter word anyway. It's important we understand what MEC is, why it came about, what it is, what we do about it, and why sometimes we need to avoid it, why sometimes it's not a bad idea. In the late 70s, early 80s, little history lesson for you here. There was something that was invented called a universal life insurance policy. And at the time it was invented, it was a crazy world. People were getting really good interest rates. Prime rate was also like whatever it was, 18, 19, 20%. That was bad. Mortgages were expensive, but you can get money if you saved money. And life insurance had always enjoyed a benefit from the IRS, as they said permanent life insurance is tax-deferred vehicle. Grow your money, use it, not pay taxes, everything's great. Well, Universal came along, and at the time, the carriers were presenting that you could get 12, 14% in this policy. Drop in your money, and it's going to grow. You never have to do anything, and the illustrations looked beautiful. The problem with illustrations, as we all know, they are lies. Depending on what side of the columns you look at, which side of the ledger you looked at. And what happened is because it was such an attractive vehicle at the time, people were saying, okay, I want $57 worth of death benefit, and I'm going to drop in $1 million of premium on this. IRS said, all right, that doesn't make sense. There are a couple of exaggerations in there, but they were buying the minimal amount of death benefit they could and dropping in the most money they could because they wanted to get the 12 to 14% without having to pay any of the insurance, because it was insurance. There are costs associated with it. But if the insurance is so low and you're getting 12 to 14%, this is a beautiful plan, right? The IRS said, all right, you're kind of taking advantage of what we intended here. There has to be a minimal amount of death benefit per premium dollar, so to speak. So they put in the DEFRA, TEFRA, the MEC 7-pay testing limits, depending on the product you look at, that say, is this a life insurance policy or is it really an investment? A life insurance policy that's meant as an investment. So the rules were put in place. That's the history of where MEC became a thing and where we are today. When we think about whole life and what it offers, no matter if it's a MEC or not a MEC, tax deferred growth is going to occur. If it is a modified endowment contract, a MEC, client is going to be faced with taxes and possible penalties if they access the policy. And accessing the policy in the IRS's eyes is a withdrawal or a loan or unpaid interest. Loan interest could be potential distribution. We'll cover that later in the presentation. So most of the time, if we're looking at funding a whole life policy, your typical DFL structures, if you will, we're complying with the MEC rules so that we've got tax-free access to it now. We avoid paying taxes. We avoid paying penalties on gains. And at the end of our income generating lives, working lives, when we can utilize this policy in a different way other than just getting us out of debt and building a warehouse of wealth, we've got the ability to get all our money back plus the gain without paying any taxes. However, sometimes that's not the best strategy for your clients. If our client has a large sum of money and we're looking to utilize it, maybe qualifying for the amount of death benefit that has to be supported by that premium you're putting in makes it less efficient. I asked this question once before. I'll ask it again. It came from a conversation I had with an agent who was dead set, cannot be a mech, cannot be a mech, cannot be a mech. Don't want to pay taxes, don't want to pay penalties, whatever. I said, okay, fine, here's your solution. He's like, well, I never make money. I never break even. I said, yeah, but you don't have to pay taxes on it. You avoided it. I said, wouldn't you rather have some gain in the policy and pay taxes and penalty, depending on the age, if you knew you could get gain? I'd rather have gain than never having it at all. Seems to make more sense, but perhaps I'm too rational sometimes. I mentioned the penalty, want to rewind. Everybody understands where the penalty comes into play. Taxes is ordinary income tax based on where they're at. The insurance company sends a 1099 form. They fill it with their taxes. Wherever their tax bracket is, that's what they're responsible for on the gain portion. Penalty is if they're under 59.5, it's an extra 10%. Flat period, 10% that they have to pay for accessing the cash before 59.5. With that, let's talk about single premium as possible solutions. My good friend Scott just brought up one. It's an annuity alternative. If cash is sitting there designed to provide income, annuity is a great solution. There's so many good ones out there. But a lot of times clients are talked into putting money into annuity because they didn't know what else to do. The rep they talked to said, well, here's a great place. It's not really going to hurt them, except it's not a great transfer vehicle. And if they don't want it for income, it doesn't really work. Or perhaps how many times in your own lives have you come across a client that looks like an annuity money, but you can't pry it loose because they don't want an annuity. Here's a solution. It's the single premium whole life. Final expenses. There's one product out there, final expense. It's simplified issue, guaranteed issue, all that, usually small face amounts. Simplified issue and guaranteed issue sounds awesome, but guess what? There's a price for that, and it comes in the performance of the policy. If your client can be underwritten, go through Horizon Legacy, go through our Horizon Value as a single premium, put them through underwriting. If they're going to get through, they get far better value out of that than they would the other products. Charitable giving. There's a number of different ways. The first presentation I'm going to share, it's actually a PowerPoint. Verbally went through this in Hopewell with you all a month or two ago, whenever that was. Time's flying. It's called Smart Money, and I'm going to see how fast I can share my screening for you. Scott, can you enable me? Oh, got it. All right. Hopefully everybody sees my presentation. Scott, nod if you see it right. Thank you.
You're good.
Your next $50,000 sale. Before I begin, this is an important part of what we're discussing today. Mutual trust producers are prohibited from giving tax or legal advice unless you have such designations where that makes sense for you to do so. Clients should always consult with the tax or legal advisor of their choice. Dividends are never guaranteed. We'll talk about those a little bit today. Always see policy and riders for provision for full details. If shown, which I will show, values we're going to include illustrated dividends, which are never guaranteed. Guaranteed cash values are based on interest rates of 3% for Horizon Value and Horizon Legacy, and 3.75% for Horizon Guarantee, which is a product we won't talk about today. Offset by expenses and mortality charges. I have met my compliance requirements for the day. So everybody, I appreciate you guys being here. As always, I hope this to benefit you, and the best way it benefits you is by thinking about clients you're about to meet with. Think about clients you've met with last week, last month, last year. You take good notes on what they have. You do your deep dive into their financial plans, into their families. You're going to recognize opportunities where this is a sale for you. So take notes throughout. Please ask questions. And lastly, as I just said, think about those. And when we're done with this presentation and when we open, our sales team is going to be ready to assist you with questions you have, illustrations you need on this. We'll begin the discussion by talking about the client. Who is the client that this is going to be attracted to? And the client we're talking about here has leave it money. Okay. Jeff Sigworth, my friend Jeff Sigworth, heard him tag this. There's single premium solutions that are either for leave it money or live it money. This part of what we're talking about tonight, this is the leave it money. We'll get to the live it later. It's going to look a lot like this, but we'll get in more discussion about it. So our client here has got leave it money. I'm sorry, agenda. I'm talking about the client profile objectives, the solution, a case study, and then more. So our client profile is typically going to be 50 or over. Why 50 or over? Well, this is leave it money. The further we are away from that retirement age, whatever that is, 67, 70, 65, whatever they need it to be, whatever they desire it to be, the further the further away they are, the more questions come upon, are they really going to not need this money? Closer they are to retirement, the better idea they have of what the retirement plan looks like, easier to identify that this is truly leave it money. So 50 or older, somewhere close to retirement, maybe even in retirement. They value access to money over return, or as Mark Twain said, I value return of my premium than return on my premium. It needs to be there. It's rainy day money. The assurance that it's going to be there whenever it's there is most important. It's not that they don't want to return. They want strong guarantees that it's there, but they'd like some kind of return. And we've got the solution for that. What they're looking to do with this money, they'd like to leave it to the kids, to the grandkids, or even maybe do a charity. And because this is a life insurance solution, underwriting is important. So do good field underwriting, figure out what their story is. They're in decent health, even a table 2, even a table 4, even a table 6, table 8. This is a solution that will resonate with them. Recapping their objectives, leave something for the kids, the grandkids. Looking for strong guarantees, which includes must have access to the funds for those rainy days. We'll talk about one of those rainy days later. And lastly, it's not that they don't want to return. They're looking for competitive return, but that's not the driving force behind their decision on what they're doing with this money. Where would our client that fits this profile currently have this money? Well, if you can think of the places where I know I can get it, it's not at risk, readily accessible. I've just described bank accounts, right? We're talking about savings accounts, checking accounts, maybe a CD sitting in a money market account, and maybe in a can or a safe in their house, maybe even buried in the backyard. That seems like not a bad idea these days either. But it's somewhere not doing a whole lot. Could be in an annuity, as I mentioned. Annuities aren't a great transfer vehicle. One clear way, take a look at an annuity your client has. If it's marked, labeled, payable, or if it's transferable upon death, they're not planning to use it for income. This may be money for the solution. Or you may be meeting with a client who's about to sell a home. They're moving into the they own 2 homes. They're selling one. They're moving into their retirement home. They're going to have a windfall. They're getting an inheritance or recently received an inheritance. Selling a business, getting a windfall. These are all opportunities where this solution will work for them. Let's look at the single premium whole life solution as it addresses each of these objectives. 1, the money we transfer into the plan is going to provide them a guaranteed death benefit. We're talking about whole life, the beauties of whole life. The most sexiest of words is guarantees. The idea that your client knows exactly what they're going to have. We take an asset, We transfer it into the single premium solution, and we have an immediate increase to the benefit, to the asset itself. Because it's whole life, because it's a mutual trust whole life policy, where we strive to create the products that will give the very best early guaranteed cash values to the client, your clients are going to have peace of mind. And I'll demonstrate that in a chart here in a second. Again, with whole life comes the guaranteed cash values. The growth that provides liquidity, access, and control. Liquidity, access, and control has been Mutual Trust's mantra for the whole 18 years I've been with them. And I love to take credit for bringing it, but that's always been our attitude. A Mutual Trust client is an owner of Mutual Trust. And as owner, they have first right of refusal to their cash values. They may use it whenever, however they would like. Talked about the what ifs before. When we think about the senior market, those retirees, it's one of the major concerns people have in retirement. It's health related, right? Maybe the greatest risk to our wealth. What happens if something happens to me? Well, in this case, I'm going to share our client's going to put away $100,000. If that $100,000 is sitting in a money market account and something happens to them health-wise and they need to use that money, what do they have access to? $100,000. If it's in a whole life policy with the chronic illness rider, we give them access to far greater than just the $100,000. And the best thing is, and we'll really get into this in the second part of this, we've got multiple product options. What I'm going to quote for you here today is Horizon Legacy. I think it's perhaps the finest single premium product solution out there in the marketplace. And a marketplace where we saw with the 7702 pricing changes, marketplace thinned out. We stayed, and our product looks as good as ever. So let's draw this out. Let's have the conversation with the clients. Our case study is a 65-year-old female, mostly because these are the numbers I've memorized. And just what we're demonstrating, make it a 60-year-old, make it a 55-year-old, these numbers all translate and all work. Our client has $100,000 sitting on the sideline. It's leave it money, not doing anything but being there for them. It's making 1/4 point of interest because interest rates are up now. And maybe they don't give away toasters anymore, but it's getting a little bit of tiny interest, but it's there. Well, Mrs. Client, what if I can show you a way that we can take that $100,000 and we're going to transfer it from this financial institution to another financial institution, Mutual Trust Life Insurance Company. Upon that transfer, we're going to take your $100,000 that you are planning to leave your kids, your grandkids, and we're immediately going to increase that benefit to $177,000. Oh, and remember, this is a life insurance policy. So what do we know about the 177? Tax-free, correct? This is a modified endowment contract. That matters on the cash value. It does not matter on the death benefits. So, Mrs. Client, today we can take that $100,000 and give you a 77% increase. Does that sound intriguing to you? Mrs. Client says, it does, but what if I put that $100,000 into a CD? Or I've got that $100,000 in a CD right now. Won't it grow to be $177,000? Well, most certainly it will. Let's generously give Mrs. Clients a 5% interest rate in their CD. Rhetorically speaking, does anybody have an idea how long it will take for her to get to $177,000? Well, because we're going to have growth and taxes, growth, taxes within the CD, it's going to take roughly 20 years, give or take. Now, Mrs. Client, I certainly hope you live another 20 years. I don't want anything happening to you. But is there a peace of mind in knowing that today we can take that asset and add in a nice 77% increase to that benefit for your kids and grandkids, would that not go a long way for them? We think it will. Mrs. Client, rather than a CD, says, I have it in an annuity. Okay, great. Taxes come later. How long will it take? Again, 20 years by the time we account for the growth at 5% and account for the taxes. We'd love for you to live another 20 years, but what if you don't? Mrs. Client is now intrigued by what we have to offer and is curious about how this is going to perform. How does this work? When we take the $100,000 by that single paid up death benefit, you will see that we will have a guaranteed cash value in excess of $95,000. By the way, for all of you straining to see the numbers, we have an agent piece and a client piece available to you at our website. Look under the marketing materials at the Agent Resource Center, and we have a one-page flyer. And if you come and see me in Denver, if you're going to be there, I'll have some of these accessible for you too. But our cash value in year one is $95,000. Now, if she puts it into a CD or an annuity, do they have penalties? Does she have full access to $100,000? She does not. So we're asking Mrs. Client, hey, we're going to give up use of a portion, small portion of that money in order to have that $177,000 death benefit. But the good news is your policy is really going to grow, and it's going to grow nicely. In year two, the guaranteed cash value is $98,000. Now, everybody understands within a whole life policy, it is a contract. And this is the easiest contract of them all, a single premium one. The client is only required to do one thing. Oh, I guess two. They have to give us the money and they have to leave it there. Give us $100,000. Your policy will be, I believe it's $98,506 in year two. Guaranteed. We can't change it. If we tried to change it, we would find ourselves in a court of law. Heard Scott mention earlier, Pan American Mutual Trust is going to do a whole lot of things to keep ourselves out of law, out of court. Changing how these policies perform is not something we're ever going to do. We can't. The interest rate within the policy is fixed. The expenses are fixed. Everything is fixed. It will happen. Your cash value in the end of year two will be greater than $98,000. In year three, policy gets a little bit better. Our guaranteed cash value at the end of year three is over $100,000. So what does Mrs. Client have? At this point in time, if she decides to walk away, it was a no-risk proposition, wasn't it? She's got all of her money back, but she won't want to walk away because within 10 years, that policy will continue to grow. The guaranteed cash value is $118,000. What bank product is going to get her there? Not many. And what risk associated with this? There is none. Now, we've been talking about the guarantees, but there's something better. There's something else we can hope for. Can't guarantee them, of course, but dividends. We are a participating mutual whole life company. We exist for the benefit of our policy holders, and our policy holders get to participate in the profits of the company, and those are passed along through dividends. Mrs. Client might decide, hey, that dividend looks like neat little Christmas present money for all the grandkids. She can choose to use it that way. Or she can say, hey, I'm going to reinvest those dividends back into my policy, back for the later benefit of my kids, my grandkids, and I'm going to buy paid up additions with my dividends. It will increase the value of the cash value in the policy. It'll increase the death benefits. So let's rewind to our objectives and take a look and see if we've got a solution that works. Have we left a tax-free? Have we left a benefit for the kids or grandkids? Yeah, not only the $100,000, we left a tax-free death benefit immediately of $177,000. She doesn't have to wait for that. It's not X number of years later that will be there. It is tomorrow. Tomorrow is not guaranteed. I hope none of you have to encounter that, but the truth is, it happens. Tomorrow she would have her grandkids would have 177,000. Do we offer strong guarantees? Definition of whole life. Do we have access to the funds? Certainly. It's rainy day money. Should something happen to her, she's got the ability to take a policy loan. She can withdraw the dividends. She can use this cash for what she needs to. Do we offer a competitive return? Yes. Whole life is the best safe asset class vehicle in the marketplace, especially single premium. And do we offer protection for the what ifs? Yeah. One, she can borrow the money. She can get to it if she needs to. And if it's chronic, if it's a medical related thing, chronic illness or terminal illness rider gives her additional protections. Starting to transition to the second part. Actually, before I go, Scott, comments and any questions that we have?
Yeah, so you're talking about a primary use of this vehicle, which is, the leave money.
Yes.
Part, right? So I guess you're getting ready to go into the live money side of this. Okay.
Absolutely.
And then we've got one more thing, the sales concept that we're here, that I'm here for, which is something we'll go into a little bit later, I guess, is the duplication strategy and the speed limit associated with that. So we'll cover that in just a few minutes, I guess.
Yep.
But for me, these that number, when you looked at that 65-year-old female example, as you get younger, these things from a performance perspective, because you've got younger, healthier clients, does the age affect performance? And you've got cash value growth that you're demonstrating. Isn't the DB growing as well?
The death benefit, if the dividends are being redirected back to the policy, dividends are buying paid up additions, which does increase the death benefit. So we paid a dividend every year for the last 100 plus. We anticipate we'll continue to pay dividends based on that premise. That death benefit in 10 years isn't going to be 177. It's going to be something more than that.
And if you're investing in PUA with the dividend, that is increasing the DB, but isn't that also increasing the cash value?
Absolutely.
So you're hitting both pieces.
You're hitting both
right?
pieces.
Right.
Yep. So in 10 years, it's not going to be 118,000 of cash value and 177 of death benefit.
Right.
It's going to be more of both.
Right. Okay. Just a quick question I saw in chat, Kaleo. Anybody can do these programs if there's an insurable interest. There has to be an insurable interest if you're writing these programs not on yourself.
Correct.
So that's standard insurance industry rules.
Correct.
Okay.
Something, if you've got a situation, what I always recommend, our sales team is there for you. It looks like a client opportunity, but it's not cut and dry. It may not be a little bit normal. Give our sales team a call and just say, here's what I have. How can we structure this to meet their goals?
I got one comment too, just in addition to what you just said, Mark, because I had that conversation with Fred Medrano in Utah about this exact topic. And his comment, which should always be the case for all of us, if you've got something that's questionable, besides reaching out to the sales team prior to submitting the application, you can always attach a letter, and a letter explaining the problems that you anticipate up front goes a long way with accelerating the underwriting process. So don't be afraid to communicate with the underwriters.
Mm-hmm.
I just wanted to ask a quick question, Mark. Hi.
Hi, Mickey.
So I understand that the Horizon Legacy is for the leave it money, maximizing the long-term death benefit. So the cash value is something we don't really want to access unless it's an emergency. Is that it?
Well, by definition, and I'm really going to get to the live it part later, and more of this will become clear for everybody. The Horizon Legacy is the best single premium solution for a client, but it's somewhat limiting. Pardon me, somewhat limiting in terms of how a client can access how they can access. Policy loans are the only available avenue for them outside of withdrawing dividends. The cash value is a component of the policy itself, and to withdraw that means you have to reduce the death benefit. But they have full loan capability. If they've got 100,000, they can borrow 95% of that, just like a normal, as you're accustomed to with the traditional DFL whole life policy.
They can withdraw it tax-free.
It is a MEC.
Okay, so this one, yeah, they don't withdraw it tax-free, but they can.
Remember, all these single premium solutions are
Yeah.
MEC.
Right, okay.
Mhm.
Hey, Mark, can we talk about that for just a second? Because, we still have that, the MEX got this, I guess, dark cloud hanging over it, but it's really not that bad of a thing. So if I put in $95,000, or if I put in 100,000, I've got 95 I can borrow, and I borrow $90,000. I'm not going to owe tax on $90,000. As long as I'm 59 and a half, right?
Correct.
I'm only going to owe tax on the growth component.
Mhm.
Okay. So if I do this on day one, this is something we'll get in there. If I do this on day one, there is no growth yet, but there will be a taxable event. I am going to receive a 1099 at some point in the future, right?
Correct.
Unless
And
I've
we
paid the
will
loan back.
outline what it looks like.
Okay.
Yeah. You notice in the first 2 years, back to where we know, assuming only guarantees. Dividends will make this a little bit better, but we still break even in year 3. My cash value is 95,000. I put in 100. My cost basis is 100. My value is 95. If I borrow 95% of that, now there's no taxes because there's no gain. You have tax-free access to your money. Year 2, there's still no gain. I can do a loan in year 2. There's no taxes. Year 3, it's 100,582. I think that's the number. So if the client borrowed 90,000 out in year 3, the first $582 that comes out is taxable. The
So it's
rest
last
of the money,
in, first out.
last in, first out.
Right.
So you're taking your gain. IRS wants their money, so they're going to get it. The rest of it is yours. Your cost basis increases to match the fact, to account for the fact that you've already paid taxes on that, so you won't pay taxes ever again.
All right, Mark, one of the things I wanted to make sure that people understand with specifically with this. So if I took the loan of $90,000 in year 1, but I'm stringing the loan along and I'm paying whatever my loan service fee is for year 2 and year 3. In year 3, the program has made a profit. And I've got 90,000 out, which I still haven't paid back. There's going to be a taxable event in year 3 because now my basis, which was 100 to start, now I've got 100,512 in there. So even though I borrowed 90,000 in year 1, I'm going to owe tax on $512 in year 3, even though I didn't take a new loan. Is that correct?
In year 3. Hey, let's hold that, Scott, because our series of illustrations will cover that.
Okay.
Rather than talking over myself. So the leave it strategy is easy. It's there. We know the clients can access it. If they access it, there's things you have to know, the penalty on the, taxes on the gain, etc. Regarding age, sorry, I skipped over Scott's question. The single premium solution, how does it look for younger clients? It's a product we priced for the senior market, but it doesn't look bad. If you take a 35-year-old, you put 100,000 in it, the growth might be a little slower, mostly because they have further to go to age 121. So the growth just happens a little bit slower than it does at the older ages, but it still works. It's still something you can talk about. I am going to share again, and let's get into The illustration I want, bear with me. Are you seeing a Horizon Legacy? Excellent. All right, good. And pardon me, my screen's now, this is over on my right. So our client, this is a case Scott and I worked on. Make you all dizzy. Our client's 65. They've got 343,000 that they're going to drop into this plan. We're using Horizon Legacy in this case. 343,000 immediately provides a $567,000 death benefit. The goal of this client, or the objective is this of the client, is to utilize the money right away. Okay, so we're going to take a significant loan. Our basic illustration is just here's the premium, here are the values. Our supplemental is going to demonstrate what happens when we utilize it. In this scenario, our client is going to borrow 200,000 out for their purposes. Footnote, everybody understands mutual trust will allow a policy loan 10 business days after the policy is in force, correct? Yes, this is truth. What is also truth, we are not able to illustrate a loan in the first year. So on the software, the loan is demonstrated to have occurred in year 2. Going back to the basic illustration for just a second. 343 in on a guaranteed basis. When is my gain guaranteed and non-guaranteed? My gain occurs in year 3. Everybody sees and agrees. Okay. What happens when the client takes a loan? Let's go through some different assumptions. The client's going to borrow 200,000 out, and they're not going to do anything towards that loan. They're not going to pay the loan interest. They're going to roll the interest into the debt. So it's an increasing loan balance each year. In the first year, the $200,000 is charged interest. In the second year, the loan balance is actually $208,008. That's charged interest. In the third year, or the next year, 216,000 is charged interest, then 224. The policy, the loan value is growing because the loan interest is in there. Unpaid loan interest will compound. As we look at this, in year 4, we've got a tax due of $469. That is because the loan interest, the IRS deems that as distribution. I don't know why, that's their law. Sort of makes sense, because otherwise I would just take my money, let it roll, not do anything, and basically get to enjoy my gain. They would tax the loan interest in this case. So based on the gain that was in the policy at 28%, which you can see at the bottom of the screen is the default interest rate used within software. On the client tab, if you know or want to use a different interest rate, you may change the income rate for that client and it would be reflected in the illustration. We're defaulting to 28%. We've got a tax due. Each year, as we roll the interest into the loan balance, IRS says that's distribution. We're going to charge you we're going to charge you accordingly. So that tax due is it's 20%, it's 28% of the gain, or 28% of the loan interest, really. And as you can see, the cost base is going up because it's saying, well, you pay taxes on that, so you're not responsible for it anymore. If we take a look at how the policy is performing, let's look over on the right, my net cash surrender value and my death benefit. We understand that the death benefit is going down because mutual trust is going to take part of the death benefit proceeds and pay off the loan first. Beneficiaries get the rest. The whole death benefit is still there. The policy still has a $567,000 death benefit. What's shown here is what the death beneficiaries would receive. The net cash surrender value works similarly. The whole cash value is there because money didn't come out of the policy. We gave it to you from our general funds. So the cash value is in the policy, still growing based on the contractual terms of the policy. But what's shown there is basically a surrender value. If you walked away at the end of year 3, we're going to pay off the loan with your cash value. You get the rest. What happens as we add in the interest and roll the interest into the policy is if it doesn't outpace the growth in the policy, it's going to dilute the cash values to a point where this blows up. And if we look at the bottom of the ledger pages, hopefully you can see it clearly. I think you can increase the zoom on this. In year 24, there's a negative 543 in the loan column. That's saying this is going to blow up. The client's got to pay 543 towards the loan for this to still have any value whatsoever. In year 25, that goes to, they have to pay $13,929 to still have any kind of value within the policy. Without that payment, this policy lapses.
Can I ask a question real quick, please?
Yes.
So that makes sense. You know, we took out that big loan because they wanted that 200,000. So what the beneficiaries would get is dropping because of the difference with the loan and the cash value. But so why would anyone want to do this then?
In this particular case for this real client, we did 3 scenarios. This is what happens if you take the loan and you don't ever pay it off. This is scenario 1. Okay. Then we've got 2 more scenarios we're going to show you. But the reason why you would do this is because I'm taking $343,000. I'm putting it into a program where I'm going to get immediate cash value, immediate legacy. I'm going to be able to use that, some of that money in this case, and pay off a mortgage and free up those mortgage payments, which I'm going to use to repurpose for other things. So this is more than just this isn't the only thing you would want to do with a client. Okay. There's other things that we're doing with the money that make this an advantageous process.
Mm-hmm.
And
so I wouldn't do this with a client.
Yeah. And Mickey, it was a great question. And I just had to pause. I'm like, because my answer is a client shouldn't want to do this. It kind of doesn't make sense. And as we progress, this is establishing an understanding of when you do this, your client has absolute access to this. They can use this cash value. This client, they're 65. Maybe he's working, maybe he's not. He's got $343,000 of cash that he wants to get into a policy. If I try to do this on a non-MEC basis, what's my death benefit for him going to be to get 343 in? It's whatever number. It's 2 million, 3 million, 1.5 million, whatever the number is. If the income doesn't support it, now we've got an underwriting problem and we've got to make this fit. And at 65, how long is it going to take for him to get whole? Paying for the privilege of not paying taxes doesn't always make sense. So this is where the single premium solution is really good. But we got to understand, like all policy loans, they're debts. If unpaid, how will it affect your policy? So let's turn our attention now. We see that We took the loan, we didn't pay anything back. We eventually had taxes. And if they were under 59.5, it'd be worse because it was penalty too on top. So let's make an assumption that our client, same exact client, 65, 343 going in, same death benefit. I haven't changed anything except for let's service the loan.
Here's your aha moment, Mickey.
We just used $200,000 to pay off the mortgage. Have we freed up cash flow for the client? Yes.
Yep, mortgage payment's gone.
How can we use that cash flow to help them? We put $343,000 in the policy. Boy, it would be nice to see us get that back, right? The very least, let's just pay the loan interest. Let's float the $200,000. We're going to use that. We're going to use additional cash flows for other strategies. We take the $7,700 loan interest, 3.85% of $200,000. We pay that loan interest every year. The magic here, I still have gain, right? Contractually, my gain is guaranteed in year 3, just as before. Nothing on this page changed. This is the exact same as we saw before. We take the $200,000 loan, we pay the interest. I don't have any taxes. Oh, disclaimer. Scott and I were playing and we used dividends to pay down the loan. Using dividends to pay the loan is a distribution, so the IRS dinged them. If we didn't do that and rolled the dividends into the cash value and death benefit, there would be no tax due. The only reason that shows up. But if I maintain those payments, I avoid any taxes. And by maintaining those payments, my interest is $7,700 every year. Look what happens to my cash value.
So Mickey, just in particular for this case, I just want you to understand what we did was, this is actually a 2-part program. This is a $400,000 mortgage that this gentleman and his wife had. They have $686,000 of cash sitting in a checking account. So in this case, we're putting in half into each program. And this scenario, this is a $19,000 per year swing on what their annual expenses are. So by doing it this way, we're freeing up $19,000 a year. So what I'm doing here, $7,700 a year is going to go pay debt service on this loan from this policy. And we're doing the remaining $12,000 into other policies.
And remember, the loan's illustrated in year 2, but when can Scott do this with this client?
10 days.
Yay, Mickey. All right, so let's get to the third. Same thing. Let's just make another assumption. It fits, it doesn't fit the strategy, your choice. We took $200,000 out. We're going to pay the interest out of pocket. And we're also going to throw $500 a month at the principal because we freed up cash flow and we have it. Doesn't have to be this way, but what happens when you do? Again, my dividends in this case are being used to reduce the loan balance further. So that's a distribution. You do have some taxes. Take the dividends, buy paid up additions, don't take them out. The taxes are gone. You whittle the loan balance down. It was just there for demonstration purposes. But now, as I pay down the loan, I've got better cash value accumulation because I'm paying the interest out of pocket, which is decreasing as I pay down the loan. And if you structured this, I can even maintain a $7,700 interest payment, and some of it would go to cash values. I can put it in a paid up addition rider if I use Horizon Value with a Flex PUA. I've got cash values that increase, and now look at my death benefit. It's increasing because I'm reducing the loan obligation. the lien is going down. The whole death benefit's always there. The beneficiaries are going to get more.
So in this scenario, we've repurposed about half the money that we saved from the mortgage payments. And this particular family, they do house flips. So in this case, one of the concerns was we want to use it, we want to eliminate the mortgage, but we also want to stay as liquid as we can. So in this case, we're staying liquid here. And then we're using some of this money, actually, the extra that's not being spent on the mortgage payments that we're saving on the mortgage payments, we're using that to fund 2 DFL programs. So you're going to have growth in the other 2 programs as well. So we're reserving $280,000 for their next purchase if they find one, or when the market settles down next year and becomes a buyer's market. So they're being prepared for that. And then this is just going to be something we're going to cycle through annually. Did I steal your thunder, Mark?
No, I am transitioning again.
Okay, I have a stupid question. Because I am not a tax person, never wanted to be a tax person. So you said you have this and they also have DFLs. So if you have interest on this, and you have taxes on this, but you're using your money from your DFLs to pay some of this, so you pay the loan interest, you don't have taxes.
No, we're not taking money from the DFL to pay this. We are eliminating 2 mortgages with this.
Okay,
Okay, so we're eliminating $400,000 of mortgage payments with this and the other companion policy. And that frees up $19,000 a year in mortgage payments, principal and interest payments, because the mortgage is gone. And then we're taking that freed up money to pay the interest on these plus $500 a month. And then we're also using the balance of that to fund 2 DFL programs.
I sure am glad this is recorded. But that answered my question, because I was like, okay, if I'm borrowing from this to pay this, the IRS not catching on or what? But okay, you answered my question. Thank you.
I was just thinking, if your client, when they eliminate their $400,000 mortgage, if they're including their taxes in their mortgage payment, they're not going to have anywhere to send those. If they took every month a portion of their taxes, real estate taxes, and applied it to the loan balance, what will that do? Reduce the amount of interest that they'll have to pay for the year. And then when taxes due, what will they do? Oh, now I'm just going to borrow it back out. I'm going to use it. Little line of credit.
Yeah, that's that dollar cycling process that we talk about all the time.
All right, let's transition now. Single premium with a non-single premium product. How do we do this? We can. And there's some cool scenarios where this is right. And the first I would say is, in terms of accessing the cash value, if a withdrawal is something that has to be able to occur, either because you know it, or you're not really sure and you want to give them the most flexibility, Horizon Value as the single premium solution is a better choice for that client. The reason being, again, cash value, the product itself generates cash value. Horizon Legacy, all those cash values were because they were the product. They are the policy. They're embedded in it. It's one and the same. You can't withdraw it. it's tied to it. There is a way, it's messy. You don't want to do it. But it's in there. So you can't withdraw. You can only borrow. If I need to withdraw, I'm going to do it with a horizon value. I'm going to sell a very small death benefit, $10,000. Under age 40, it would have to be 25,000, but the smallest death benefit I can comes at a cost of 371. That's not a whole lot. I'm going to take the rest. This client here is 50. I'm going to take the rest of the 100,000 that this individual has, and I'm going to put it into a single paid up addition rider. It is essentially a little single paid up policy within the whole policy. So my cash outlay is 100,000 year one. Now this is a premium paying till age 90 product. Does the client have to pay it? No, not at all. Let's go to my illustration page. And pardon the size here, I'll do my best to walk through the numbers. We have 100,000 going in year one. The cost of the insurance, that $10,000 is $371 per year. We're going to pay them from policy values. Client doesn't have to do this. If they got 371 to throw at it, it'll make it better, but they don't have to. We've got cash value. We've got gain in year three. Dividends are buying paid up additions. And almost from the onset, by year three, the dividend is greater than the premium. So then our death benefit starts to grow. This is the same type solution, the same type of loan activity, payment activity will all still apply. But let's put a twist on this. What if it's a single premium solution where the client actually has cash flow to keep funding? Thinking about what I'm doing here for a second.
I know where you're headed.
That could be dangerous.
And you designed it as a level instead of money exchange like we do for DFLs.
Right, because I still want, I just want the minimum death benefit, so I knew what that was. And this is a mech, so I don't care about the death benefit. I've got my $10,000 death benefit. I'm going to add a flexible paid up addition rider on this. And I'm going to set it to the minimum premium amount, $100. I solve for a maximum of 10,000. I just put that number in. It could be bigger. It could be 25,000. What kind of cash flow freedom is your client going to have from utilization of the plan? That's your number. Hey, we're going to free up 2,000 a year we can put into this. Let's take it. We can make it 24,000, 50,000. You can make it up to 100,000 per year. The policy is already a mech. I don't care about the death benefit. That's fine. However, the more you make that, the more it does affect the underwriting death benefits, not the initial, but we account for what could be paid and underwriting assumes it would be. Within my ledger, my clients, the 100 extra, so $100,100 year one. That extra 100 is for the flex paid up addition rider. They're paying the 471 out of pocket, 371 on the death benefit, $100 for the flex PUA. In any of these years, they've got 10,000 more they want to throw in it. They can throw it into it. Payment of the premium increases the cash value even more.
Mr. Creighton?
all kinds of cool ways to construct your single premium and make it a single premium that's not really a single premium. That doesn't have to be a single premium.
That is a 96.46% efficient program.
And so I just wanted to ask, so this is for access. So you would withdraw from the cash value, and if you didn't pay it back, it would just come out of the death benefit as per usual. At the time of withdrawal, are you paying, so you're paying taxes then because it's a MEC, but of course it's still growing beautifully, so that's okay.
Wait,
I didn't know that you guys, I never thought about this one.
hang on. What's the difference between a loan and a withdrawal to the cash values?
Well, is the withdrawal on the dividends?
In this structure, because the bulk of the money went to a single paid up addition rider, that cash value is accessible through a withdrawal. In a single premium policy, Horizon Legacy, you cannot withdraw anything but dividends. But always remember for your client, what is the intent? If it is to use and pay back, loan is your answer. If it is to get and not pay back, because they've got an emergency, their kid's in a bind, they need 20,000, they're going to give it to them and be done with it. They're not expecting to ever see that money again. A withdrawal makes more sense. They're not carrying loan interest, building loan interest on it. But once you withdraw money, it's no longer in this.
Sorry,
It's out of-
I want to make sure I wrote that. I want to make sure I wrote that down right. Can you just say that last couple sentences just one more time, please?
the part about policy versus rider.
Well, I think what you said is that the whole single premium money they put in, that's accessible when you're doing the single premium Horizon value. But when the only dividends are accessible, that's Horizon Legacy.
Correct.
Okay.
Through withdrawal.
And withdrawal is, so with withdrawal with the Horizon Legacy, we're talking about when it's not taxable. No, when it is taxable.
These single premium policies are modified endowment contracts.
Yes.
No matter if we use Horizon Legacy or Horizon Value, they are MECs.
What's the loan versus withdrawal then? Because I thought one was taxable and one's not, right?
IRS deems them all distributions. Otherwise, everybody would just borrow money, not pay it back, and get their gain. IRS says that's not fair. We want our money. They deem a withdrawal or a loan a distribution, and they can be taxable.
Then why are we differentiating between withdrawal and
On a
loan?
MEC.
Okay. The differentiation comes from what is your intent with your clients and what is the best solution for them. If withdrawal is something that the client has to have, use Horizon Value because you can withdraw value out of a rider. You cannot withdraw value out of a policy.
So is the difference that you can withdraw and it's not something that you need to pay back in the way that if you don't pay back a loan, it reduces the death benefit. If you withdraw, it's not reducing the death benefit.
A withdrawal reduces death benefit by more than what you withdraw.
So
in my head, this is clear as mud, so let me explain.
What was it? What was it that you said about cannot withdraw anything but dividends? Maybe that's the sticking part here.
that's the
In
Horizon
all right,
Legacy.
Horizon Legacy is our true single premium solution product, right? Everybody understands that.
Yeah,
The cash value, the guaranteed cash value in the policy is part of the contract and cannot be withdrawn, period.
but can you just
It
say,
can be borrowed against.
like, what is the difference between withdrawals and loans then?
A withdrawal removes the cash from the policy and can never be put back. a loan, the cash value is actually still there. There's a lien on the cash value for the amount of the loan balance, and it can be paid back.
Got it. That's what I was missing. It's the cash value difference, not the death benefit.
Right.
Okay. Thank
Let's take Scott's clients who are interested in, once they get rid of their mortgage, they're going to house flip. How are they going to access the cash value? It's got to be a loan if they want to do it more than once or twice. Because when they buy the property, fix it up, flip it, replenish the program so that when the next opportunity comes, it's there to use again. All the while, it grew the whole time as per the contractual terms of the product. They paid interest for the use of it, but not a full year's if they sold it within 3 months. They paid a quarter of 3.85%.
Yep. And if they did that, then they're going to get arbitrage.
Yep.
Their gain's going to be higher than their cost.
So I'm harping on, and pardon me, everybody, I'm harping on this. The interest has been overwhelmingly incredible. And Scott, I thank you for that. It's gotten a lot of attention, and there's a lot of questions on utilizing the cash value then. Okay, we know how to put this in place. We know what we want to do. What's the best way? True single premium or horizon value, and understanding getting the money, how and what it means to do it. Because it's a mech, understand the taxes. You could put your client in a position where, yeah, there's no gain right now. You have absolute access to that. You're not going to pay taxes. You're not going to pay penalties. You're paying nothing. Well, there's no gain. But if they don't respect that debt, they're going to get a 1099. They're going to give you a call and say, what'd you do to me? We want to cover this up front. We want to make sure you know how to present this, that you know your client's going to utilize it correct. We don't want you to use your E&O insurance. And we want to continue
you
to
can only do that once.
to keep joining these Thursday calls because I like them.
Using your E&O insurance is a one-time get out of jail free card, and then you're no longer in business.
So I would just like to say for myself, I will never have Scott Forehand's brain. Never. Here's my question. Is there a minimum single premium that we can use for either of these policies? I mean, these are all shown with a huge single premium. Is there a minimum single premium that can ever be used?
Yes. On Horizon Legacy, it is the premium required to buy $5,000 of death benefit. I think I just said that right. So depending on the age, that'll give you the number. Horizon Legacy also goes to age 85, something to consider. So at 85, the premium for 5,000 is like $4,200 or something like that. So, but at age 35, it's far less than that.
That's a final expense policy on steroids.
Right. Horizon Value, I think the lowest single PUA premium is $500, but this wouldn't look good if the client wasn't going to pay premiums. You have a $371 cost of insurance. The $500 would cover it for year 2, and then it blows up in year 3.
Okay, thank you.
Yeah. So relative to the strategy, there kind of is with Horizon Value. Mickey, did we answer your questions?
You absolutely did. And I'll never have your brain either, Mark, but I only have to worry about it for another couple of years. I won't be doing this anymore. I'll be retired. So
My wife would tell you you're blessed if you don't get my brain.
I think, Mark, this is shedding a lot of light for people, but I also think it's probably still confusing for a lot of folks. So I think we're definitely gonna have to do another one of these. maybe
Yeah,
at a conference.
I would love it. I see Norma has a question.
Yay, Norma.
I do. I have a couple of questions. So my first question is, if you have somebody who's intending to take loans anyway, what's the big difference between Horizon Legacy and Horizon Value?
Really, the big difference is Horizon Legacy performs better, depending on the age of the client. Long-term better cash values and better death benefits. It would be the preferred way to go. But you limit the client in terms of, again, can't really withdraw a whole lot. Only dividends. Dividends are always able to be withdrawn, borrowed, whatever. Horizon
Can I add one thing?
Value.
Sorry, Mark. It's age. The difference is age.
Probably.
Is that right?
Long and short, yeah.
So tell me, expand on that just a little bit. So let's say I have a client who has $250,000 that he wants to put in one of these, and his intent is to borrow from it and to pay it back over a period of time. And he is 48 years old. So what's my go-to?
Okay, I'll answer this in this way. From an age standpoint, 48, again, Horizon Legacy was priced for the senior market. So 48 is on that cusp of what's better. So Horizon Value could provide some better short-term numbers that will look better, okay? I will answer it in terms of you as an agent. Get to my page that I want to get to. If you were to show a single premium illustration, the Horizon Legacy, our true single premium product, $100,000 goes into the product. The ledger looks easy. There's no premium column, right? It's zero after the first year. And the rest is, you explained. If you show Horizon Value where they're not going to pay anything out of pocket, you have these columns. I have an annualized premium outlay. There's 371. What's it for? Because we have to have a base death benefit. It's the smallest I made it to make this most efficient for you. But I don't want to pay premium. But you're not, because look, we're actually paying it from the policy values. Look at the column right here. So from a explaining standpoint, if you can get over this hurdle, if you don't want to deal with that column or that explanation, Horizon Legacy is just easier. If this doesn't give you an obstacle, then maybe the values at 48 are going to be better short-term in Horizon Value for your client than they would be in Horizon Legacy. Make sense?
All right. And if I have somebody who is, let's say 60 years old, is that enough of a difference? Let's say 70 years old.
70, Horizon Legacy will have better short-term numbers. Pretty sure. Somebody can go start running software on me and challenge.
No, yeah, you're right. Yeah, and
Yeah.
Horizon Legacy outperforms for actually age 60. I think it's 67 and older. Horizon Legacy outperforms Horizon Value.
Long-term,
Okay.
it will. Yeah, long-term, it will outperform it also.
But as long as they're planning to utilize loans as opposed to withdrawals, then from a certain age up, the Horizon Legacy is going to probably work better for them. Is that correct?
Yes, correct.
Okay. My other question is, of course, we're kind of APV conscious here at Symmetry. And when I enter my Horizon Value into our opt and put my APV, I get to put the APV on that $10,000 base premium. So my question is,
Yep,
I
your
know
APV is $371.
Right.
Yep.
And so my question is about commissions on the two different products. That's my second question.
So your commission schedule should be available to you through Quility based on your current commission level. If
But
you
that
don't
doesn't
know,
tell me what you're paying on the paid up editions.
if you don't know what that is, if you haven't looked at it, it's on there. So each person is different based on their commission level. So on that commission sheet that's available through Quility, it tells you what your commission is based on PUA versus term core policy versus term rider versus whole life. And the primary difference between the single premium whole life legacy versus Horizon value is going to be the Horizon legacy is going to have a much lower APV. However, because it's computed like an annuity at Symmetry. So if you, like in the case of the 343,000, the APV for 343,000 for me is 343.05 is 17,150 APV. And now obviously with Symmetry, that's going to be capped because you can't have more than 7,500 APV. But in the end of the day,
well, that's only for the leaderboards. That's not for your commission.
APV means nothing. It doesn't have any, really has no effect whatsoever on anything we do here, other than maybe an occasional contest or something. So from a commission perspective, you got to look at the commission chart because it's based on your commission level. Does that answer your question?
And so, yeah, and so that will isolate the paid up editions, the commission on paid up editions from the single premium.
The single premium whole life is essentially all paid up editions. It works like an annuity. So your APV is going to be about 5% of whatever the annuity is capped at 7,500. Okay. And then what you actually get paid is what you actually get paid. And that's based on your commission level for that product. And that's on Quility, on the Quility master commission chart, which you have to be an agency owner or above to have access to that. So if you don't have access, then ask your upline to look at it for you based on your commission level.
Scott, I can answer. If you don't know your mutual trust commission schedule, you can also go to the agent website. It's available for you there. Under agents reports, book of business, navigate through the book of business tab. There is a section there where you can look at your commission schedule. Generally speaking, if I were to compare 100,000 as constructed here versus 100,000 Horizon Legacy, Horizon Legacy would provide a higher comp than this.
That's what I figured.
However, I also base this on the lowest death benefit. If the base death benefit was 50,000, this would actually provide probably a little bit more commission. So you can manipulate. However, when you do that, what happens? This column goes down.
Well, yeah, the cash, cash surrender. Yeah, of course.
So,
of course. But all other things being equal, if I had a toss-up, I've got a 50-year-old, and so the two, they're performing pretty close to each other. The only difference between the two, because we're going to access that cash value through loans, the only real difference between the two is my comp. So that was my question: is the legacy paying better, or is the Horizon value paying better?
It's not going to be equal though, Norma. All things aren't going to be equal because the usability of these two different programs are different for each client. And what you just described to me, I would be looking at a way to duplicate the funds, find that sweet spot in the single premium whole life where I can say, okay, we're freeing up this much money. We're going to have this much money that we can use to fund your DFL. We're going to use some of that to pay the single premium whole life back. We're going to borrow money from the single premium and fund that DFL and duplicate some of the funds. So for me, I would do both. If you've got somebody that's that close to being on the line, I would do both.
I'm sorry, what do you, both of what?
I
I'm
would
missing something.
separate the funds into two separate programs, one being the single premium whole life, which I will borrow some money, do the math, find that sweet spot, take the money out, whatever the portion is that I can take out, where I can keep the single premium whole life fully funded for the rest of the life of the client, take that money, put it into the DFL as a duplication strategy, make sure I leave that PUA room so that if I'm starting with 50,000, I can put in 50,000 to the single premium whole life. Maybe I take 17, maybe I take 20, maybe I take 22, wherever the number is, take that 22,000 out, do the same process with the DFL, but then have my max fund my DFL program in year one by taking that 22,000 out of the single premium, dumping it into PUA for the DFL program. And now I've got the same dollars in two places working at the same time.
Okay, Scott, you keep talking about DFL program. Are you talking about infinite banking? You're talking about an infinite
I'm
banking
talking about a
program?
Horizon Value program. It's a standard program, the standard DFL that we do. So I'm saying in the hypothetical example you just gave, a 50-year-old with $50,000, I'm going to do a single premium whole life, put $50,000 into it. Let it sit there for 10 days. I'm going to take out wherever that number is based on the client. How much money did I free up? How much money do I have now that I can use to fund that DFL program with the regular monthly payment? Okay. So in the example of my clients, we got a $1,900 or $19,000 a year mortgage payment. Okay. So I'm going to take some of that money. I'm going to do the math like what we did here. I'm going to figure out how much money do I need to pay that single premium, how much money am I going to pull out, and how much money do I need to pay back that single premium on a monthly basis so that I'm not going to have a taxable event and I'm not going to have a decreasing value policy. Whatever's left, I'm going to use as a monthly payment structure for the DFL, for the Horizon Value program. And I'm taking some cash out of that Horizon Legacy and I'm putting it into the DFL as seed money to start that. So that I can then, hopefully this person's got some debt. I can start debt snowballing the debt and actually duplicate. And what I'm doing is, this is the duplication strategy. This is what I've been talking about. How do I duplicate the money? I can't do it all, but I can take some of it, maybe in some cases, maybe more than 50%, and still keep it a fully functional policy where I know, because I can illustrate it, it's not going to fail for the client. It's going to be permanent. The single premium whole life will be permanent. It will continue to grow the death benefit. It will continue to grow the cash value. It's on automatic pilot. And then I'm taking some of that money out to fund a DFL to be seed money for that year one DFL. And then we start talking about strategies. I'm going to predate the DFL so I can get that money in there recognized as 6 months earlier, and then start the DFL. Okay. Now what I'm doing here, because we're talking about commission, right? I'm shooting myself in the foot on that commission because I'm taking the money out of the single premium whole life. I'm pre-funding the DFL 6 months early, and I don't get paid a commission on that. But I don't care because it's what's right for my client. I'm duplicating my client's funds because I don't get paid a commission on PUA that gets funded prior to the actual date of issuance of the policy. So if I predate it 6 months, I'm not getting paid commission on the PUA, but I don't care because it's what's right for my client. You understand? It's a little convoluted.
I do.
But
I've never heard of predating the PUAs, and I did miss a little piece of this. I had to go have dinner with my husband.
So it's not predating the PUA, it's predating the policy. So if I write a policy today, I can click that box on the policy and say, I want to backdate the start date, and I want to start it 6 months earlier. That's all I'm saying. So when the funds actually hit the program, when I'm doing the single premium whole life, that happens on the day it happens. When I'm doing a predated DFL, I can say I want it to start 6 months ago. And so when I take that money from the single premium whole life, put it back into my checking account, let it commingle with my funds, and then take the money out of my checking account and pay the front loading of that DFL policy, which I'm predating for 6 months early, then I'm not going to get paid a commission on that money, and that's okay. But for the client, the policy is going to be predated 6 months early, and there's going to be having a piece where they're going to have an immediate, there's 6 months going on, 6 months compounding, 6 months growth, and then if I'm doing this right, and I'm like maybe I'm taking 20,000, but I'm not taking it all at once. Maybe I'm only taking 10,000 now because I've got a really streamlined DFL policy that I can only put in $10,000 a year. In that scenario, predating 6 months, I'm putting in 10 months as I'm putting in 10,000 as if it went in 6 months ago. And now in 6 months, I'm putting in the additional 10,000. So I'm max funding the program for 2 full years within a 6 month period of time. And that, when you start talking about the maximizing the growth being as an efficient program as possible, that's the most efficient way I can come up with, to where I'm going to get the maximum amount of money with the least amount of pain in for the client, and then really get that, supersizing that growth, because you got 2 years of interest coming up, and you're really doing your client a solid when you do it that way. Shooting yourself
And
in the foot.
in that scenario, you're using the Horizon Legacy.
I'm using both. I'm putting the money first.
For the large drop in, you're using Horizon Legacy. Is that correct?
Yes. And then I'm deriving.
This is where my confusion comes.
Okay.
This is where my confusion comes. And maybe, I just talked to Mark a couple of days ago about this, and I'm still confused. Because I wrote two Horizon values last week, and what I'm hearing here, I could definitely have used the Horizon Legacy in both of those cases.
Maybe.
Unless I've heard
Now,
everything
look, if you're
wrong.
talking about Mark Barnes, Mark Barnes is a smart cookie. He knows his stuff, right? Actually, everybody at MTL is great. So, but
I'm talking about the guy sitting right next to you on Zoom.
Okay.
Well, the good news is we can revisit this, and if Horizon Legacy ends up being, let's talk about this, Norma, give me a call. Talk about your individual clients, and if Legacy is the better product, the cool thing about an application, we can change it.
Okay.
It's all the same app, right?
Okay.
Love that.
Yeah, the underwriting really isn't going to be a whole lot different, so you don't take a step back. We just change something.
Oh, Mark, I got to plug your e-app system for just a second. There's a little box for all you guys that are out there. If you're using MTL's e-app, there's a little box you can check to actually make that one application be for multiple programs. So you don't have to do all the data entry twice. So in some cases, I've actually done 3 applications just by checking that box and say, oh yeah, we're also applying for a Horizon Legacy at this. And oh yeah, we're also applying for another Horizon value at this. And here's copies of all the illustrations that I upload with the app. Now, for those of you that are doing that with Symmetry, Symmetry is going to be confused as hell. And they've had to explain it to them a couple of times. No, this is one application, but I'm using it for 3 policies. There's 3 separate policies at MTL right now. That's why I put each copy of each application in there with a copy of each new illustration, and I renamed them each time. So you have to do that. I would put that in your agent notes when you're uploading into Symmetry so that they understand what you're doing.
Can I ask a question about the predating? I don't know if we're out of time or anything here, if this is a question for a later time, but can you talk about that again? Because you get the 6 months compound interest, everything. How exactly are you doing that predating?
I'm checking the box on the application that says back date to save age. And I'm choosing the date 6 months prior to the date that I'm doing the application. It's not going to get issued on that date because we still have to go through underwriting. But that's putting MTL on notice that I want to predate this as soon as we're able to go live. As soon as we're able to issue, I want it issued on that day. That's 6 months earlier to the time we're ready from underwriting.
And then once it's issued, you'll pay those 6 months of premiums.
Well, it depends. Am I doing a monthly premium or am I doing an annual premium?
Point of clarification, don't write to save age because the only backdate as far as saving age works, just backdate 6 months is what you want to say. If they're illustrating a monthly premium, yes, they owe 6 months of premiums in addition. So you got to cover that, and whatever funds you have going into that program has to account for 6 months. If it's an annual premium they're paying,
Yeah,
almost
then-
no reason you wouldn't want to backdate, because you have to pay that either today or 6 months ago. It's an annual premium. So there's
Yeah.
no harm, there's nothing to negotiate or maneuver around there.
Okay.
I have a question.
That's
Okay.
DJ Debt Free, everybody. Hello, DJ Debt.
Hello.
Okay.
Forgive me for being behind. Someone put this in my calendar at 5:30, then switched it to 7. I'll forgive that person. With that being said, I'm sure you answered this, Mark, and talked about it. I'm just gonna ask you, so I save you a phone call.
All right. You owe me a phone call anyway.
Yeah, I know, you're right. And that's why I wanted to come here and ask it. It's been like, I have 2 cases. One, a woman who has durable power of interest, power of attorney, durable power of attorney, just moved her aunt into her home. The aunt has 400 grand to park, but needs the money to use as well. Obviously, at 89 years old, she's not going to qualify. Can the aunt, does she have insurable interest on the niece? Because if the niece goes down, the aunt is, SOL. And if she did a single premium whole life with the 400K, could she have access to money to be able to use it? Would it be worth doing?
Aunt is being taken care of by who?
Niece.
The
The niece. The niece is the sole heir to her throne. She's in the will. The niece has durable power of attorney and is taking care of the aunt. The aunt just sold her home and has 400 grand to park somewhere.
Aunt is gonna put money on the niece.
Well, that's
Niece
just
is
my
the
suggestion.
Okay, niece is the insured, aunt is the owner.
Correct. Number 1, can they do that? Number 2, does single premium whole life
There's-
work here?
There's insurable interest because the niece is taking care of the mom, so the mom has the niece is taking care of the aunt. The aunt has financial interest because if something happens to her, she's got to go find care. So insurable interest is there. The issue will run in here. $400,000 is going to buy a lot of death benefit on how old's the niece?
66.
Oh, all right. It's not that bad.
How much does the niece make income wise?
Yeah, this is going to be the hurdle in the sale is the amount of death benefit. That would be the point of discussion on that, but doable, yes.
The
In
niece
all,
probably- I'm sorry.
all 400, maybe not. Some, yeah. Some to all of it, depending on the specifics.
The niece makes about 60K a year. So obviously, if there's a limit,
420.
multiple of 7.
Yep.
No, 10. I think we're 10.
She's 66.
Yeah, I don't
The
think we go
65
down
to 70,
below
isn't
10.
it times 7? For
I
people.
don't think
over
we go
60.
below 10.
Okay. Well, then you got 700,000.
So 100,000 on a 65-year-old buys 177. 400 would buy 750-ish. Might have a little bit of trouble with some of the death benefit, but doable in there.
The key here is that the aunt still needs the money, not all of it, but needs money to live. Right, that's her living money, and the niece.
She
is
owns it.
managing that pot.
She owns it. She's got access to the cash value, correct?
Okay,
She can do whatever she wants to do with the money.
great.
Death benefit, beneficiaries in that case, either a fallback option to provide care if something happens to the niece. If it's another family member, that would be a justifiable beneficiary. I think it could be the aunt herself because she'll have to pay for care. or the niece's spouse would be a good
The
choice
niece
there.
actually has a son. The son is the fallback of care, and the
Okay.
son is also in the will.
Okay,
Okay, I have two of
justifiable.
these. I have the second one. Now it's not her mother and aunt and stuff. It's just her 67, 220 grand. Obviously, single premium whole life, access to the money right away. And she makes 100 grand a year. So I don't know. You tell me. This is what I was calling you about.
Not be a problem at all.
Great.
On the last scenario, would that create a taxable event for the niece, the 400K?
No, the aunt still owns it, only if, presumably, the aunt would make the niece co-owner or contingent owner. At that point, can be
Yep.
taxable to her.
Yep.
Talk to your CPA.
Perfect. I live with mine,
There you go.
and she adores you. So
And DJ, on that first equation, the first agent, you'll be able to derive $11,000 a year income from that, and it will not be defeatable. It'll never go away.
that's good to know. Thank you for the quick math.
Okay, so
But
tell
that's
me,
if all 400K goes in, correct,
Correct.
Scott? Okay.
so Mark, please tell me. I couldn't even get a $15,000 final expense, and all our final expense say the same thing, cannot be purchased by a POA. So how can a POA not purchase a final expense policy, but they can purchase your policy?
In this case, I'm sorry, this is an easy one, Mark. I like easy questions, so I'm going to step right in. In this case,
You
the
go.
fact that the woman has durable power of attorney is irrelevant. That doesn't affect insurable interest. In this case, the woman is the caregiver of the woman who wants to be the owner of the policy. That is what provides insurable interest, not power of attorney.
But this was the husband of the wife.
I
So
don't know
the
about your
husband of the-
situation. I'm talking about in DJ's situation.
I know, but
Why-
I'm saying the husband couldn't even get a $15,000 policy for his wife as a POA.
Is the
but-
wife unable to sign an application?
It was questionable.
Okay, so if the wife is unable to sign an application, then there shouldn't be an issue. If the wife is able to sign the application, then the fact that the husband's POA doesn't mean anything. It's irrelevant. You do the application, the insured signs the application.
Okay, so as long as the
Now,
So
you
as
sounds to
long
me like
as-
you were dealing with Mutual of Omaha.
I was trying to deal with everybody,
Yeah, sometimes those
Didn't-
folks are a little
didn't
dense.
matter. All right, thank you.
All right, we have exhausted for this evening. Anyone last minute question, or Mark Creighton, any last minute words of advice to our folks here?
One, when you have questions, give me a call. I say this all the time, and please do, because there's usually about 5 text messages per day I get where I have to figure out who they are. I apologize if I haven't already put you on your phone. So if you text me, introduce yourself first so I can save my, introduce yourself so I can save it. Save your number and I'll always know who it is. My cell phone is 630-333-0522. And one of the greatest advantages Mutual Trust has is the sales team that sits behind us. Not literally, but they're there for you. They're incredibly experienced, incredibly knowledgeable, and looking forward to helping you all out. Reach them. Mark Barnes is my direct partner. You don't have to talk to him. You can reach any of them. Mark is at 630-684-5470, or call the MTL number, 800 number 323-7320. We changed our phone system, so it's not an extension anymore, but it's the very first option, number 1. So if you forget I say number 1, you don't have to listen long. Just hit 1. You'll get through the sales team. They'll help you out with this. It is our absolute pleasure. It is our honor to serve you as agents and your clients, and we look forward to it. We ring a bell every time an app comes in, not literally, but we do in our minds. We celebrate applications.
Can
They're
I
what they're what allows me to keep being here with you. I probably could still do it, but I wouldn't get paid as much, but I'd still do it. I'd still join you. But it lets us have the fun we have supporting you. So for that, we thank you all. I hope you're all in Denver again. Look me up. We got a table there. I forgot what space we're at, but we're there. Come say hi to me. If I've never met you in person, I want to do it there.
Thank you, Mark. DJ, you had one last question?
Yeah, I had a yes, no, or maybe. Right. And I'm sorry, my internet dropped, the light went out, so I would ask Sereni. That situation I just talked about with the aunt and the niece.
Mhm.
It's not your area, so I'll take the maybe. Could that be challenged legally by a family member?
And owning it.
Aunt's owning it on the niece.
Does she have a cognitive impairment?
Not that I'm aware.
Does she-
It might be dementia and stuff.
Right. So and that's where your challenge would come in. Your challenge would come in is that the contract challenge is, does that aunt have the mental faculties to be able to sign and enter into a contract?
Yeah, she has a son that she's completely cut out. So
Okay. Well, I mean, that's the question that I would say. Could it be anything can be challenged in court? There's, you can sue
Okay.
somebody because you don't like the color of a sweater they're wearing. It doesn't matter. You can sue anybody for anything. But you could challenge it in court if you have some kind of proof that says the aunt has a mental impairment.
appreciate that.
Yep. Did I miss the mark?
Nope.
Maybe you can get like a doctor note ahead of time saying she's not mentally impaired before you do the policy.
Well, it's listen, if you're gonna close this with this, I'll make you smile, right? The son and the daughter-in-law made the aunt sign a check to them. The aunt doesn't remember signing it. They took her to court and won that she signed it. And that she didn't have a mental impairment, so they could get the money. So now, if they were to challenge this, the only way they could challenge it is she does have a mental impairment. This is what I was calling you, because I want this money parked at mutual trust in your hands, buddy. I told you that in Hopewell. And
Well, that's Bruce. She's crazy now, but no, yeah, I'd get some clarification. And she doesn't like him at all.
no, he's cut, he's gone, goodbye, nothing, never getting it done.
I was gonna say, if there was a good relationship there, co-beneficiaries, where each of the kids would benefit from it, would help potentially.
All right.
All I do is records.
Thank you. Thank you, everybody. Enjoyed this. We'll do another one of these specifically focused on SPWLs later on after conference, maybe September, maybe last week of August. Thank you, everybody, for showing up. Great questions. Love the interaction. Thank you, Mickey. Thank you, Dr. Burr. Thank you, Keith Fonseca, and everybody else that participated. And thank you so much, Mark, for showing up and pouring into us. We'll never be able to say thank you enough, and we really do appreciate it. And you guys are wonderful. If you haven't had an opportunity to work with anybody at MTL, they're the best. Super easy, super friendly, attentive, awesome folks. Thank you very much, Mark.
Scott, real quick, when is your next training?
I do not know yet, because right now we got a lot going on. It'll be
Okay.
after conference.
Okay,
Okay. And
Thank
I
you.
always announce it in Slack, on the Purdy Slack, and we'll usually on the debt-free living, which is changing, we'll be announcing those on those moving forward as well. All right.
Thank you.
All right, everybody.
Thank you,
Have a great
Scott.
night.
thank you.
Thank you.
Good to see you
Thanks,
guys.
everybody.
Bye-bye.